Hello, all. Welcome to ETF Edge, your go-to program for all things ETFs. Our guest today, three of the best in the business all the time. Jan van Eck from Van Eck Vectors ETFs, Tim Seymour, founder and CIO of Seymour Asset Management, and Doug Jonas, head of ETFs for the New York Stock Exchange. Doug, I want to start with you and the big picture here. The rally is producing enormous inflows into ETFs. Just check some of the new numbers here. $400 billion in inflows so far this year. That's only the second time that's happened, that we passed $400 billion in a single year. And we just passed $5 trillion in assets under management for ETF. That's a real milestone. What are the major themes for 2021? And are we going to continue to see these kinds of big inflows? Or is this just due to the rally that we've been seeing in the last few weeks?
Yeah, Bob, I mean, you really talk about this record-breaking year ETFs have had. 2020 has been amazing. If we look at the lows from March to where we are today, about $2 billion per day is coming into net cash flow into U.S. ETFs. And so it's just been a tremendous year. And it's been a year of about opportunity. And also, you and I had discussed at the beginning of the year, would 2020 be the year for active management? And the answer is playing out in the form of yes. Active management this year, $45 billion in cash flow, almost double what we saw last year. But more importantly, it's been about growth. If you look at all the ETFs launched this year, half of those were actively managed ETFs. And so it's about active managers coming to the ETF marketplace and really showing their worth. And we're seeing it in both transparent ETFs, but also these new semi-transparent ETFs. ETFs where a manager doesn't have to show their holdings every day. We now have 15 of those that are in the market, 750 million in assets already. And so it's really been about the intersection of opportunity for growth, and then active management really coming and playing and showing their own in the ETF world.
Yeah, active management. We've been waiting for years for this to start moving a little bit. And it makes a lot of sense because right now the active management community is in trouble. They need to find a lower cost way to do business, and the ETF wrapper seems to be the right way to do that. I want to return to active management, but Jan, let me ask you, the inflows, it looks like in the last several weeks, they're all in equity ETFs. There seems to be big outflows from bonds and for gold. Is that going to continue into 2020? We've been talking about this, will we ever see outflows from bonds ever? It's been inflows for years. Do you think there's actually some legs to this story?
Yeah, I do, mainly because of the macro outlook and the fact that, the 10-year is so low. It's below 1%, right? A year ago, it was 1.8%. Now it's 8. What the phrase, I don't know how much you've been talking about this, but the phrase we've been talking about with clients is the 40% is broken, meaning the 40% of your portfolio that's supposed to be in bonds. And, institutional investors, advisors, individuals, no one wants to own a bond with that low an interest rate. So I think there will be that combined with our house view, which is that global growth is really underappreciated, meaning interest rates could go up, which would be bad for bond prices. So I think that, look, bonds are still, I think, $1 trillion in the ETF universe, so it's not zero, but I do think bonds face headwinds.
When you say it's broken, you mean that old 60-40 paradigm, which I never agreed with to begin with, doesn't make any sense anymore? Is that what you're trying to say? Is that what you mean when you say it's broken?
Yeah, that's exactly right. And, the great thing about treasuries, at least, is they provide a negative correlation to the rest of your portfolio. So bonds would typically rise like they did this spring, government bonds, when the rest of the world is having a tough time. But people are looking for alternatives to those diversifiers. They're looking at gold and other things. So, listen, some of the money movements with bond ETFs aren't bad. People are use ETFs for targeted exposure, and that's why you've seen some of the outflows. We have an ETF, a fallen angel ETF, which is a high yield ETF, and that's seen steady inflows pretty much all year long since March. So, different ETFs for different uses.
Yeah, I want to get back to the high yield in a minute because I know you've got some of those funds. But, Tim, let me turn to you. This value rally, this is like the oldest story in the book. We've seen fits and starts in value all throughout the year. Nothing has lasted at all. But I'm wondering if this one actually does have legs. All the value ETFs are up 15 to 20% this month. Doesn't matter whether you're talking about the S&P, the mid cap, the small cap. Even European value is up I think 17% on the month. that qualifies as like an eye-opener to me. I don't know, does it have real legs at this point, and why so, Tim?
Yeah, and you know, European value has almost been an oxymoron for the last decade, and that's part of where you're going with this. You know, if we think about what's been working, you know, and value is, of course, measured relative to itself. So there are sectors that are cyclical, but certainly, you know, are trading in value territory. And I think, yes, there's an argument in favor of industrials, transports, banks, even emerging markets. And some of this comes with, you were just touching on the conversation with interest rates, and I just use the term normalized because I think we even get back to 140 to 160. 160 is really kind of where, if you look back, is where we started the year, and 140 as we really got into the teeth of COVID. I think you're going to continue to see that rotation, which would absolutely be benefiting banks, and banks on a relative basis are value territory. Some of the industrial names are benefiting not only from COVID trends, but also bottom-up fundamentals. I mean, look at the auto sector and look at some of those fundamentals and the fact that Ford and GM, as an example, are companies that have been value names for years. I mean, GM has been, you know, arguably a waste of an allocation for almost 5 years, and is now appearing like it's starting to move on company-specific fundamentals, but also this sense that you're, and Jan referred to this too, just that you're getting an industrialized response from the market, and you only need to begin to price in the beginning of a recovery to get this. I would just caution, though, we've seen this rotation multiple times in the last 6 months, and people were claiming growth was dead, triple Qs were dead in May into June.